TSP just dropped a brand new Lifecycle Fund, the L2075, and I have been getting tons of questions about whether you should jump into this new Lifecycle Fund 2075 or just keep doing the individual funds or just go all in on the C fund. Look, I get it. When something new comes out, everyone wants to know if it's worth their attention. So let me give you the breakdown of everything you need to know about this L2075 fund, compare it to the individual TSP funds, or how this compares to what some people do with 100% in the C fund. Just don't do what I did when I was active duty in the Air Force and just put 100% in the G fund because I didn't pay attention to it. First, let's talk about what this L2075 fund actually is. And this thing was born on June 30th, 2025. So it is brand new and it's targeting investors who were born in or after 2009. Now, if you're watching this video, you're like, man, I wasn't born in or after 2009. And you're probably thinking, wait a minute, that's not me. Well, this fund may be designed for people who are going to retire around 2075, but it doesn't mean that everyone else outside of the age group cannot invest in it because it's all about the stock bond allocation you need to pay attention to. So in 2075, I'll be 90 years old. Now, if you go over to the TSP website and look at the L2075 fund, you will find the full breakdown of how this thing is put together. And like all life cycle funds, it is a mix of the 5 individual TSP funds, GF, CS, and I funds. For July 2025, the L2075 fund's allocation targets are the following. The G fund, which is the government securities fund, takes a tiny 0.36%. And this tiny silver is your sleep well at night money. And the G fund is basically like lending money to Uncle Sam. It's backed by the full faith and credit of the US government. So you're guaranteed not to lose your principal. The lifetime average return on the G fund is approximately 4.65% since 1987. And over the past 10 years, it has returned on average of 2.65% annually. And think of it as your financial safety blanket if you're trying to be conservative. For the F fund, or the fixed income fund, it's another small slice of 0.64%. And this fund dives into the bond market, which is basically you lending money and getting paid interest in return. And bonds typically move in the opposite direction of stocks. So when the stock market becomes rocky, bonds often provide some stability. Except in 2022, when inflation skyrocketed, both stocks and bonds suffer significant losses. The F fund has returned on average of 5.29% since 1988. And over the past 10 years, it has returned an average of just 1.88% per year. For the C fund, which is the common stock fund, and this is the big kahuna and making up 51.48% of the L fund, and it is where more than half your money is going to be working. And the C fund mirrors the S&P 500, so you're essentially buying tiny pieces of America's biggest companies. So think Apple, Microsoft, Amazon, or Google. And when people talk about the market going up or down, they're usually referring to these heavy hitters. And it's aggressive, but historically, this is where the real wealth building happens over the long haul. And since the C fund was introduced in 1988, it has performed at an average annual rate of 11.19%. And over the past 10 years, it's returned an average of 13.62%. As for the S fund, or the small cap stock fund, it's coming in at 12.87% in stock allocation. And this is your aggressive growth potential play. And small and mid-sized companies often have more room to grow than the big established players, but they can also be more volatile. And think of companies that might be tomorrow's Apple or Google, but haven't quite made it to the big leagues yet. And it's riskier than the C fund, but the potential upside can be substantial. And since the S fund was introduced in 2001, it has performed at an average annual rate of return by 9.23%. And over the past 10 years, it's returned an average of 9.22%. So it's about the same as the past 24 years. I fund, also known as the International Stock Fund, takes a significant chunk at 34.65%. And this fund gives you exposure to companies outside the US, European giants, Japanese innovators, and emerging market players. It's smart diversification because sometimes when the US market is struggling, international markets are thriving. And case in point, in 2025, plus you're not putting all your eggs in the American basket. which helps spread your risk around the world. And some may argue that the C fund has enough international exposure because most of those companies in the S&P 500 already have businesses all around the world. However, the new I fund that came out last year started to invest in the emerging markets in other parts of the world that are not in the S&P 500. And since inception, it has performed at an average annual return of 5.65%. And over the past 10 years, it's returned an average of 6.78%. So you could argue that the I fund has still grossly underperformed the C and S funds in the past 10 years. So as you can see, it is heavily weighted towards stocks, especially US and international, which makes sense for someone with a very long time horizon until retirement. And the expense ratio for the L2075 fund is estimated at 0.039%, or about 39 cents per $1,000 account balance, which is incredibly low. And that's pretty reasonable, especially when you consider that this fund automatically rebalances daily and adjusts its allocation over time to become more conservative as you get closer to retirement. And by the way, if you want to track your TSP prices and stay on top of your investments, you can always use my free TSP price tracker over at firesession.com/resources, and just a little something to help you out. Now, here's the problem with trying to evaluate this brand new fund, and it literally has no performance history. And I mean, it's been around for less than a month as I'm recording this, and you cannot judge a fund's performance based on a few weeks of data, right? And you need to see how it performs through different market conditions and economic cycles and various ups and downs. And since the 2075 fund doesn't have enough data yet, let's look at the next best thing. And the L2070 fund. This fund has a very similar allocation to the L2075, and it has been around since July 2024. So we have about a year of data to work with, and it is sitting at a 9.9% year-to-date return as of June 2025. And the thing is, we really need more time to see how these life cycle funds perform over the long haul, and the L funds are designed to automatically adjust their allocations over time and gradually becoming more conservative as they get closer to their target date. In the early years, they aggressively invested in stocks for growth, and then they slowly shifted more money into the G and F funds as they got closer to retirement to preserve capital. And it's a set it and forget it approach, which is great for those who do not want to actively manage their portfolio. But the real question for many of you might be, what about just picking my own funds? If that's your preference, then let's take a look at the individual fund performances in the TSP. You can see here that C Fund is still the long-term champ, and it has delivered strong average returns around 11.2% per year since 1988. And over the last 3, 5, and 10 years, it's consistently outperformed the others. And that kind of track record is why a lot of people just stick with it for the long haul. Now, if you want a little more action, the S Fund might catch your eye, and it can be a bit volatile and it swings up and down more than the C fund, but it's also had some really strong years. It is a solid growth option if you're comfortable with the bumps along the way. In 2020, for example, the S fund outperformed C fund when the interest rates went to zero during the COVID years. And the S fund gained 31.85%, while the C fund gained 18.31% by the end of 2020. And then there's the I fund, which covers international stocks, and it's been the top performer year to date in 2025, thanks to a strong rebound overseas and the US government imposing tariffs. And it's actually crushing it this year with an 18.69% year to date return. Compare that to the C fund at 6.18%, and you can see why some people are getting excited about international exposure. But here's where I need to pump the brakes a little bit. The I fund might be having a great year in 2025, but when you look at the longer term picture, the C fund has been a consistent winner. And over the past 3 years, the C fund has averaged 19.66% annually compared to the I fund's 15.86%. And over 5 years, it's 16.6% versus 11.3%. And over 10 years, the C fund has delivered 13.6% compared to just 6.78% for the I fund. And the most impressive number, though, is the C fund's lifetime performance since its inception in 1988. And this fund has averaged 11.2% per year or over 35 years. And that's through multiple recessions, market crashes, the dot-com bubble, the financial crisis of 2008, and everything else the economy has thrown at us. The C fund has been a workhorse of the TSP system, and there is a reason why so many people swear by it. So, with all of this information, this brings us to the $1 million question. Should you just go all in on the C fund? I have talked to plenty of TSP participants who do exactly that. They put 100% of their contributions into the C fund and just call it a day. And you know what? They're not wrong to consider it. The C fund tracks the S&P 500, which represents the 500 largest companies in America. And when you invest in the C fund, you're basically betting on the continued success of American businesses. And historically, that's been a pretty good bet. If you ask Warren Buffett what he would do with this index fund right now, he always recommends 90% in the S&P 500 and 10% in bonds, which is equivalent to 90% C fund and 10% G fund. But here's what I want you to think about. When you go 100% C fund, you're putting all your eggs in one basket, and that basket is large cap American stocks. Yes, it's a very good basket with a long track record of success, but it is still just one basket. Are we going to see a 13% average annual return in the next 30 years? Maybe. Maybe not. Nobody knows for sure. And if you talk to any TSP investors, or maybe most of them, who started investing in the 80s, 90s, or 2000s, they would go back in time to do 100% C fund all over again. But is it okay to spread your money out between CS and I funds going forward? It really depends on how you want your TSP to be exposed. What if small cap stocks, which the S fund tracks, have a great run over the next few years? What if international markets, which the I fund covers, continue their recent hot streak? Are you going to be okay watching those gains from the sidelines? And the thing about past performance is that it never guarantees future results. And I know that sounds like a boring disclaimer, right? But it is important. The C fund has been the top performer over the long haul, but there have been periods where the S fund or I fund outperformed it. From 2000 to 2010, for example, the S fund actually did better than the C fund. International markets have had their moments too. This is where the life cycle funds like the L2075 come into play, and they're designed to give you exposure to all these different market segments without you having to make the day-to-day decisions about allocation. And the fund automatically rebalances to maintain its target allocation. So if one fund is performing exceptionally well and becomes overweight, it sells some of those gains and buys more of the underperforming funds. And it is a disciplined approach that takes emotions out of the equation. And the L2075 fund's allocation gives you majority exposure to the C fund, which makes sense given its long-term track record, but it also gives you meaningful exposure to international stocks and small cap stocks. That 34.65% allocation to the I fund might seem high, but remember, this fund is designed for people who have 50 years until retirement. And over that time horizon, having international diversification could pay off big time. And please don't get me wrong, I'm not trying to convince you to go one way or another. Those are the things that I want you to consider before making the decision. So whether you are looking at the C fund, S fund, I fund, or giving the new L2075 a shot, the most important thing is that you are paying attention to where your money is going. And retirement is not just about how much you save, and it's about how well you invested along the way. So keep doing the hard work. Keep asking the right questions. What do you think? Are you doing individual funds or the life cycle funds? And this has been another beast of a video, and I hope you got a lot out of it.